Two savers turn 55 this year, same job title, same six-figure salary, same 401k plan. Both want to sock away extra retirement money using the exact same catch-up rules they used last year. One of them still gets to choose how that extra money is taxed, the other one no longer does. A single number buried in a 2025 W-2 now quietly decides which of these two savers keeps a choice. Most videos on this topic treat it as one flat rule, applied the same way to everyone affected. It is not flat. It splits high earners into two totally different financial paths starting January of this year. Here is the twist most explainers skip. Losing the choice is not automatically the expensive outcome you would assume. So which saver actually comes out ahead once the real math runs all the way to retirement? Stick around because the honest answer depends on a number neither of these two savers actually controls yet. Neither saver actually controls that future number yet, and that uncertainty is exactly where this whole story starts. Call them the veteran and the newcomer, both turning 55, both working the same kind of job. Both currently earn $180,000 a year, the exact same income, down to the dollar. Both have maxed their regular 401k contributions, and both want to add extra catch-up savings on top. For the 2026 tax year, that standard catch-up limit for people their age sits at $8,000. Until this year, both savers could send that $8,000 in pre-tax, lowering their taxable income today. Both are in the 32% marginal tax bracket right now, at least on paper today. That bracket number matters more than either of them realizes, and the video will come back to it later. This rule already took effect on January 1st this year, fully enforced, no longer a proposal in Congress. This rule runs on good faith compliance through 2026, with the final regulations becoming fully binding starting in 2027. But starting this year, one small detail on a tax form quietly splits their two paths apart. That detail is a wage threshold, and it does not care how similar these two savers otherwise look. Here is the surface-level version. Most people already believe about catch-up contributions starting this year. The rule sounds simple. High earners now have to put catch-up money into Roth instead of pre-tax. Under the new rule, any participant 50 or older is potentially affected, but only past a specific wage line. That wage line sits at exactly $150,000 in FICA wages earned the year before. That figure comes straight from the IRS, updated in November of last year for the 2026 tax year. That $150,000 line moves with inflation most years, adjusting a little higher over time. FICA wages are not your salary. They are the number sitting in box 3 of your W-2. The newcomer earned exactly $180,000 in FICA wages in 2025, well past that line. So starting this year, the newcomer's entire catch-up contribution is legally required to go in as Roth. The veteran in this story earned under the threshold last year, so nothing changes for her at all. Self-employed savers and business partners with no FICA wages are not touched by this rule at all. Most people stop the explanation right there. Rule applies to you or does not, end of video. That is the version that gets clipped into a thumbnail, and it is not wrong, just incomplete. Here is what that thumbnail version leaves out, and it starts with what the newcomer actually loses today. He sits in that 32% bracket, and pre-tax contributions get deducted right at your marginal rate. Under the old pre-tax option, that $8,000 contribution would have lowered his taxable income directly. That pre-tax move would have saved him roughly $2,500 in taxes this year alone. Under the new mandatory Roth rule, that upfront tax break simply does not exist anymore for him. He still contributes the same $8,000. He just pays income tax on it now instead of later. That is not a penalty, and it is not a fee. It is a shift in the timing of the tax bill. But timing is not nothing. Money paid to the IRS today cannot also stay invested in growing today. Economists call that lost growth an opportunity cost, and it rarely shows up on any statement you receive. There is a second hidden cost, and it has nothing to do with tax brackets at all. If a company's plan does not offer a Roth option, the newcomer cannot make pre-tax catch-up either. Under that scenario, high earners without a Roth feature simply lose the ability to make any catch-up contribution at all. That turns this from a Roth versus pre-tax question into a Roth versus nothing question for some savers. The newcomer's account size stays exactly the same either way. Only the timing of the government's check changes. And there is a third layer most people never see coming, tucked into how the rule gets applied automatically. If an eligible high earner does not actively elect Roth, many plans redirect the money to Roth automatically. That automatic redirect is called a deemed election, and it is where the real story starts compounding forward. Follow the newcomer's $8,000 Roth contribution forward in time, from this year to age 65. Assume a 7% average annual growth rate, a common long-run assumption for a diversified stock portfolio. By age 65, that single year's contribution alone could grow to roughly $21,000. Because it went in as Roth, every dollar of that $21,000 comes out completely tax-free. Now follow the version where he could have used pre-tax instead, growing at that same 7% rate. That pre-tax version also reaches roughly $21,000 by age 65 dollar for dollar identical growth. The catch is that the pre-tax version gets taxed on the way out, not on the way in. Picture him retiring into a 22% tax bracket, one realistic scenario worth running the numbers on. At that 22% bracket, he would keep about $16,000 of that money after tax. Now picture a higher scenario instead, retiring into a 32% tax bracket rather than a lower one. At that higher bracket, he would keep closer to $14,000 of that same original contribution. Suddenly, the mandatory Roth rule looks less like a punishment and more like a locked-in tax rate. Zoom out for a second. Even 10 years out at age 65, this is still only 1 year's contribution. Now widen the lens to the 60 to 63 age band, where the numbers get considerably larger. Savers in that 4-year window get an enhanced catch-up limit under the Secure 2.0 law. For 2026, that enhanced limit lets them contribute up to $11,250 in catch-up money. If they are also over the wage threshold, that entire larger amount must go in as Roth too. Assume that same 7% growth rate applies as again, this time to this larger super catch-up amount. That single contribution could grow to roughly $29,000 by the time he actually retires. Now imagine that same contribution had gone in pre-tax instead, taxed only when it finally comes out. Assume that same 32% future tax bracket applies again for this larger contribution amount too. At that rate, the pre-tax version of this contribution would lose roughly $9,000 to tax. The mandatory Roth version keeps every dollar of that $29,000, no matter what future tax rates do. That is the part almost nobody explains, because it only shows up once you run the numbers forward. All of that math looks clean on paper, but it quietly assumes something no spreadsheet can actually guarantee. 7% is only a long-run average. Real markets swing wildly above and below that number most years. It assumes both of them keep contributing the full catch-up amount every single year without skipping. It assumes neither of them touches that account early, even during a job loss or a medical emergency. This is a Roth 401k, not a Roth IRA. Early withdrawals mix contributions and earnings together, exposing part of that money to tax and penalty. It also assumes both savers actually know their real future tax bracket, which nobody genuinely does at 55. Every guess about your future tax bracket carries some risk, no matter how confident you feel about it today. There is a quieter behavioral problem too, one that has nothing to do with taxes at all. Paying income tax on Roth contributions today means a slightly smaller paycheck for the newcomer, starting right away. Some savers respond to a smaller paycheck by quietly contributing less elsewhere to make up the difference. If that happens, the tax-free growth advantage on paper never actually shows up in real life. Feel like the rules on your own paycheck keep shifting under your feet lately? You are not imagining that. The math promises a winner. Your actual behavior over the next 10 years decides if that winner shows up. And behavior is the one variable no IRS regulation and no calculator can force anyone to follow through on. So which saver actually wins, the one still choosing freely or the one the law chose for? Start with the veteran, still under the threshold, because her side of this deserves real credit too. She keeps full flexibility. If her income drops in retirement, pre-tax could genuinely save her more money. Flexibility has real value, especially for anyone whose future income or tax bracket is hard to predict today. Do not assume the newcomer simply lost. His forced Roth contributions are now protected from future tax rate hikes. If future tax rates climb over the next decade, his Roth catch-up money is already locked in at today's rate. Both paths are legitimate financial outcomes. The only real difference between them is when the tax bill comes due. So here are the actual conditions, not a single flat answer, because the honest answer depends on you. If you earned under $150,000 in FICA wages last year, this rule does not touch you yet. You still get to choose, and that choice should follow your best honest guess at your future tax bracket. If you are over that threshold, the choice has already been made, and arguing with it wastes energy. The better use of that energy is adjusting how much you save elsewhere, since your paycheck just got a little smaller. If your plan has no Roth option at all, ask your HR team directly whether that is changing soon. Without a Roth option, going over the threshold does not just remove pre-tax, it can remove catch-up entirely. And if you are 60 to 63, treat this decision with extra weight, because the dollar amounts are largest for you. Remember that $11,250 figure. For your age band, mandatory Roth carries the biggest swing either way. Back to our two savers, standing at the exact same starting line from the beginning of this video. One still holds a choice. One had it made for him and locked in a tax rate for life. Neither outcome is automatically better. It depends entirely on where tax rates sit when they both eventually retire. So which one are you? Still choosing freely, or already locked into Roth without realizing it yet? Check box 3 of your last W-2, run your own numbers, and tell us which side of the threshold you landed on. There is probably another quiet rule change sitting in your own paycheck right now that nobody has explained to you yet. This video is for financial education only, not personalized taxes, investment, or legal advice for your specific situation. Talk to a qualified tax professional before making any decisions about your own catch-up contributions this year.